This week's market behavior revealed something profound about human nature and exploitable patterns. Tuesday's violent sell-off, followed by Wednesday's sharp reversal, wasn't driven by changing fundamentals. It was driven by fear, then relief, then the herd's inability to process uncertainty. When Trump mentioned Greenland and tariffs, the market didn't price in economic impact, it priced in panic. When he walked it back, the same actors who sold aggressively reversed course with equal intensity. This is predictably irrational behavior, and it creates opportunities for those who remain disciplined. The psychological mechanism at work was loss aversion compounded by recency bias. Investors had grown comfortable with policy predictability, then were forced to reprice tail risk in real time. The VIX spiked above 20. Institutions bought expensive downside protection, and the put-call skew hit the 75th percentile. This wasn't rational hedging. This was emotional insurance bought at the worst possible time. Netflix fell, despite beating estimates, because guidance disappointed inflated expectations. Banks sold off on credit card rate caps not because of material earnings damage, but because it signaled regulatory unpredictability. Fear of the unknown, not the known. Now here's what the system revealed. Tuesday's cross-asset liquidation was coordinated de-risking. Equities, bonds, and the dollar all fell simultaneously. This is rare and indicates systemic stress, not sector rotation. The 10-year yield spiked to 4.29% while equities crashed, signaling risk premium expansion. Wednesday's rebound was mechanically driven by short covering and forced repositioning. Small caps outperformed for the 13th straight session. Energy hit all-time highs, and semiconductors surged 6 to 12%. This wasn't organic buying, this was algorithmic rebalancing and gamma squeezes exploiting low liquidity. The bond market's behavior is the critical signal. Yields rising during an equity sell-off indicates the 60-40 portfolio framework is broken. Bonds are no longer hedging equity risk, they're creating it. The Japanese sovereign debt crisis added contagion risk, proving that Fed policy alone no longer determines U.S. rates. Global capital flows and foreign central bank actions now exert equal force. This is a structural shift that most investors haven't recognized yet. Gold surged to $48.87 before pairing gains, confirming Tuesday's move was fear-driven, but it held elevated levels, indicating residual uncertainty. Major banks forecast $4,500 to $5,000 for the year, reflecting structural demand from central banks who understand fiat currency risk better than retail investors. Bitcoin held $90,000 to $92,000, while Ethereum stayed above $3,100. The 471 million Bitcoin ETF inflow wasn't retail speculation, it was institutional allocation treating crypto as portfolio insurance against fiat instability. The Stoic approach recognizes this market's true nature. Prices reflect collective emotion and positioning, not value. The geopolitical catalyst reminded us that exogenous shocks are normal, not exceptional. Systems built assuming stability are fragile. When certainty gets priced in, uncertainty becomes catastrophic. The disciplined response is to assume uncertainty is constant and position accordingly. This means maintaining liquidity, avoiding concentration, and refusing to anchor to recent conditions. The sector dispersion, energy at highs, tech rebounding, financials under pressure, indicates a market without consensus. This isn't bull or bear territory, it's transition, where old correlations break and new patterns emerge. The VIX spike and institutional hedging reveal a defensive market where rallies become opportunities to reduce risk, not add exposure. The week's lesson is fundamental. The market votes on emotion short-term but weighs reality long-term. Tuesday voted fear, Wednesday voted relief. Neither reflected underlying conditions. The weight is rising yields, geopolitical instability, regulatory uncertainty, and the slow erosion of the post-2008 monetary regime. The system isn't collapsing, it's evolving. Position for evolution, not collapse. Hold assets that benefit from uncertainty, gold, energy, crypto. Avoid assets requiring certainty, long-duration growth, leveraged credit, consensus trades. The market will oscillate between fear and greed. The disciplined observer remains unmoved, focused on process, indifferent to outcome. If you value systematic thinking over emotional noise, subscribe for frameworks that exploit human predictability. The complete Stoic exploiter methodology is available in the description. Download it to understand how theological anthropology, Stoic discipline, and value investing create sustainable edge in chaotic markets.